What's going on? Welcome back to the channel. So today we're going to talk to you about GM. I want to go over some of the data points, what's been really moving it, and why you need to add them to your watch list. Before we get into any of that, make sure you guys hit that thumbs up. And with that, let's get right to it. So GM has been on a absolute tear. So for instance, over the last 1 month, up 16.18%, 5 days alone, up 19.69. A lot of that has to do with their most recent earnings, which was a absolute amazing triple beat. So they beat on earnings per share, beat on revenue by $3.26 billion. And then they also did give very good future guidance. So they raised their 2025 guidance. And not only that, one thing that's been somewhat looming over the auto industry has been tariffs. And luckily enough, GM did say that their impact was a lot less than what they forecasted, which is rather interesting because Tesla also did have their earnings 2 days after GM's earnings, and their kind of narrative was a lot different, saying that they lost $400 million just in the quarter. So crazy stuff. So in general, GM is doing something right. Even though a lot of people always call it boring and just outdated, I feel like there is a lot of value, and this is why even on my Patreon back in August, I did post this as a buy. When it was at 58.49, I did signal that it had a lot of good opportunity going forward, and I gave a price target of $75. And so most likely that target is going to hit this week because we do have a lot of big catalysts. So potentially a 25 basis point cut coming up and possibly even a deal with China. So Trump is meeting with China. That's on the 31st. So that in among itself could be a pretty good thing for the broader market. And then we also have a lot of massive companies unveiling the earnings. So this upcoming week most likely is where my target will hit. And that'll be a solid, 25-30% just in like a month and a half on a boring stock, as what a lot of people like to call it. And analysts are starting to warm up to it as well. So most of them that have given ratings since their earnings are fairly bullish. You have one bearish one, $46 sell, Wells Fargo, Colin, who has a 47% success rating. So clearly they're making a very easy notice for themselves on who is shorting. But you do have $100, 92, 86, so a lot of big numbers here. And as a consensus over the last 3 months, that's also including a lot of the bearish ones, that it does show 73.56 as a price target, representing a 5.6% upside. In my opinion, I think a lot of these analysts are still being relatively conservative, because what analysts try to do to kind of keep their good score and their success rating is have lower targets, so that way it's seen as accurate. So this is the downfall, I guess, of analysts, because nobody really wants to be out there giving $120 price targets. And in my opinion, if 75 is hit, you could definitely see things heating up very, very fast, because even on the actual chart, there's not much willing sellers right now. So it is in a breakout type of territory right now. And one thing to take note of though, is on this YouTube channel, I primarily cover Lucid, and I've mostly covered EVs in the past, but a lot of what drives EVs is algorithmic trading. Whereas GM, even though again, it's old school, boring and all that, you have most of the volume coming from institutions. So you're not going to be seeing those massive swings that you see with Lucid, for instance. So I think GM, definitely you need to add them to your watch list just based on that. Financials were on point. So for instance, right over here, cash and cash equivalents, 29.7 billion. So that is down slightly from year over year, 7.82, but nothing too crazy. Gross margins was down about 21% from the year prior. So this is the lowest it's been since ever since it shows right here, and that's 9.37. So that's something as well just to kind of monitor. But they also did mention that they aren't going to be pursuing EVs. It's just not advantageous, and it makes sense, right? EV, the whole market is cutthroat. We saw Tesla really flop on their earnings, and a lot of that had to do with just the environment and the administration, what the administration is doing to the EV market. So I think in general, GM is doing the right thing by not really YOLOing into EVs when they technically could easily, based on how much cash and cash equivalents they do have. And one thing to take note of though, is that they actually do have Cruise. So they did purchase Cruise, I think it was in 2021 or 2022 from SoftBank. So they do have the technology to really compete compete against, let's say, Tesla, for instance, and even Lucid in some cases. But of course, GM has more than enough money to really ramp up, and they want to go a different route anyways. But I think GM, even though it still is seen as boring to a lot of individuals, needs to really be added to a lot of people's watch list. And when it comes down to shorts, I think it's definitely good to invest in a stock that is not heavily shorted. So every EV seems to be like 15% plus. Lucid's case, a little bit more, of course, but 2.34% of the free float's being shorted. That definitely is a sight for sore eyes. 22.16 million shares overall being shorted. Shorts did increase their position by about 8.4% on Friday alone, so they increased 1.73 million, but clearly that didn't really work out too well for them. So with all these crazy catalysts coming down the pipeline, you might, surprisingly enough, see shorts get screwed. Even though it's only 2.34% of the free floats being shorted, like shorts are overextended with this stock because looking at DTC, 2.52 days, so that does factor in the average volume for GM in comparison to number of shares being shorted, but it does signal technically that they are overdone. So a couple of key points to watch for going forward. Right now with it at 69.66, it is trading between this R3 and this R2. So 65.75 is going to be a strong support, and then 76.03 is going to be the next strong target / resistance. And if it's able to get above that, then in theory you could see that $100 being the next target. So like I said, I think just most likely this week we will be seeing 75 plus, and then potentially if that does come to fruition and some good catalysts, and let's say if Powell does hint to a, for instance, December meeting for that 50 basis point cut, then we could easily be seeing $100. So that would be a pretty good return on investment with GM, even from these levels. But even more reason why you need to pop over to my Patreon, because I put out tons of these value plays that hit home like crazy. Even I did Beyond Meat, a very big squeeze play, signaled it was a buy at 65 cents. And then I did put a initial target of $4. And then once that did hit, I gave 6. And then of course, at that stage, I just said, hey, you need to cool it. And most likely this is where you need to get out. And so everything followed exactly to plan. And I think same is going to happen with GM. But I'll give more updates on GM once it does hit my target of $75, but I think definitely GM needs to be added to your watch list. And if you're more wanting some dividends, it does pay 0.86%. So you probably won't get crazy rich from this, but it's a little bit icing on the cake. And so yeah, 0.86% yield is always very welcoming. Let me know your thoughts on GM. Don't forget to hit that thumbs up and subscribe. I always greatly appreciate that. And then pop over to my Patreon. I put out daily day trades, numerous swing trades, worthwhile to pop over there and take a look. So after this, I'm just going to play a quick 5-minute video just on some of the absolute key highlights from their earnings that you need to kind of take away from it. So I'll go over the good, the bad, and the ugly, and everything that you need to kind of be aware of. With all that said, appreciate all of you watching.
Earnings call insights. General Motors Company, GM, Q3 2025 management view. 𝗪𝗓𝗧𝗛, chairman and CEO, announced, "We achieved our highest third-quarter market share since 2017 with strong margins, and our restructured China business was profitable once again. We are raising our full-year guidance." 𝗪𝗓𝗧𝗛 also reported GM will more than double planned Chevrolet Equinox production at the Fairfax assembly plant in Kansas and invest close to $1 billion in a new generation of advanced fuel-efficient V8 engines in New York. The company is maintaining capital discipline while expanding domestic production. 𝗪𝗓𝗧𝗛 stated, "We have decided to more than double the planned Chevrolet Equinox production at our Fairfax assembly plant in Kansas, above and beyond what we announced earlier this year. Once these investments come online, we plan to produce more than 2 million vehicles per year in the United States." On regulatory and EV strategy, 𝗪𝗓𝗧𝗛 highlighted, "It's clear that near-term EV adoption will be much lower than planned. We recorded a $1.6 billion special item charge in the third quarter, including $1.2 billion for non-cash impairments related to the ICE transition and $0.4 billion for supplier contract cancellations. GM will stop bright drop production at CAMI assembly and assess the site for future use due to slower than expected commercial electric van market growth." 𝗪𝗧𝗡 emphasized the software and services business, saying so far this year, we have recognized nearly $2 billion in revenue from OnStar, Super Cruise and other software services, and our deferred revenue was up 14% from Q2 to almost $5 billion. Paul Jacobson, Executive VP and CFO, stated, we reduced dealer inventories by 16% year over year, ending at 527,000 units. ICE inventory is turning quickly, and we actively managed EV inventory down by almost 30% since the end of the second quarter. Jacobson added, North America delivered Q3 EBIT adjusted margins of 6.2%. EBIT adjusted margins in Q3 would have been around 9%, excluding tariffs, well within our prior margin target of 8% to 10%. Outlook. 𝗪𝗧𝗡 stated GM is raising our calendar year 2025 guidance to EBIT adjusted of $12 billion to $13 billion, EPS diluted adjusted of $9.75 to $10.50 per share, and adjusted automotive free cash flow of $10 billion to $11 billion. Jacobson stressed, we expect capital expenditures to be at the lower end of our $10 billion to $11 billion guidance range as we recalibrate our plan in light of policy and upcoming footprint changes. The company expects gross tariff exposure for 2025 to improve to a range of $3.5 billion to $4.5 billion and aims to offset around 35% of this through go-to-market, cost, and footprint initiatives. Relative to deliveries, GM expects a calendar year 2025 total vehicle SAAR of around 16.5 million units. Financial results, Jacobson reported, total company EBIT adjusted was $3.4 billion, including a gross tariff impact of $1.1 billion. Adjusted automotive free cash flow was $4.2 billion, partially aided by $300 million in tariff offset reimbursements. GM Financial posted Q3 EBT adjusted of $800 million and paid a $350 million dividend in the quarter. Diluted share count at the end of Q3 was 954 million, a 15% reduction year over year. GM China's market share grew 30 basis points year over year to 6.8%, with China equity income at $80 million. Q&A. Joseph Spak, UBS, asked about updated tariff disclosure and impact. Jacobson responded, the president's announcement included the ability to designate parts into 232 that expands the pool of eligible parts. So that's where we're seeing some savings on the tariff. Spak asked about a tailwind into 2026. Jacobson said, we need to get Korea resolved, Mexico, Canada, etc. We expect that we can be in a position where our net tariff exposure could be lower in 26 than it was in 2025. 𝗖𝗢𝗡𝗡𝗘𝗖𝗧, TD Cowen, inquired about shifting emissions regulations and ICE opportunity. Barra replied, anticipating that we're going to be able to sell our internal combustion engine vehicles for longer. When Orion comes online, that's going to give us an opportunity to fully maximize really what is a franchise for GM with full-size utilities. Mark Delaney, Goldman Sachs, asked about margin targets. Jacobson responded, so I think giving some time to adjust the business is what gives us confidence to be able to get back to that 8% to 10% level. Multiple analysts focused on EV profitability, cost reduction levers, and capital allocation discipline. Management consistently highlighted flexibility and cost controls, sentiment analysis. Analysts engaged with persistent questions on tariffs, EV losses, and regulatory uncertainty, reflecting a neutral to slightly positive tone overall, with some skepticism regarding margin restoration and future demand. Management maintained a confident tone in prepared remarks, frequently emphasizing discipline and adaptability. Jacobson stated, GM is stronger and more resilient than ever. Compared to last quarter, management tone remained confident, but with slightly more emphasis on discipline and cost control amid regulatory and demand uncertainties. Analyst tone stayed probing, but acknowledged GM's execution. Quarter-over-quarter comparison, GM raised its full-year EBIT adjusted and EPS guidance from the previous quarter, reflecting stronger than expected performance and improved tariff mitigation. the company's strategic focus has shifted further toward balancing ICE and EV production, with explicit actions to reduce EV overcapacity and reassess loss-making operations. 𝗪𝗓𝗓. Analysts continued to focus on tariffs, EV profitability, and margin restoration, but with increased attention on capital discipline and flexibility in manufacturing. Key metrics such as EBIT adjusted, free cash flow, U.S. market share, and China profitability all showed positive momentum versus the previous quarter. Management's confidence in achieving North America 8% to 10% EBIT margins was reiterated, with more detailed commentary on the levers to reach that target. Risks and concerns. 𝗪𝗓𝗧𝗪 flagged the fluid situation regarding the supply of certain chips from China, noting potential production impacts and ongoing efforts to minimize disruptions. Management cited a $1.6 billion special item charge related to ICE EV transition, battery module reductions, and supplier contract cancellations, with further charges expected in Q4 due to 𝗪𝗓𝗓𝗏 actions. Warranty expense remains a headwind, with Jacobson noting it was a $900 million year-over-year impact in Q3. Efforts are in place to address root causes and reduce future expenses. Analysts expressed concerns about macroeconomic uncertainty, regulatory shifts, and the sustainability of demand, especially for EVs. Final takeaway. GM's management underscored the company's adaptability and financial resilience in a shifting regulatory landscape, raising full-year 2025 guidance on solid U.S. market share, profitable China operations, and a decisive reset of EV strategy and capital allocation. Strategic actions to align production with demand, focus on high-return investments, and expand software and services revenues are expected to strengthen GM's position as it targets a return to 8% to 10% North America EBIT margins in the coming years.